This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. I love skepticism. I'm one of the biggest skeptics. I mean, I know there's all kinds of funny business that goes on in the government. Look at the U.S. Federal Reserve. How much funny business went on in 2008, 2009. So I get being a skeptic. I understand. But once I know the story, and once the data matches the story, I'm not a skeptic. My second book was called The Complete TurtleTrader, about a very famous story of a man named Richard Dennis and his partner Bill Eckhardt, how they took essentially non-experienced traders off the street, taught them to be trend-following traders, and it worked. In 1988, these students, nicknamed the Turtles, went off on their own. Now, all these years later, many of them are still trading today for clients. The cool thing is the experiment never ended. The trading never stopped. And it wasn't just the turtle traders, the trend-following turtle traders. So many other trend-following traders across the world have kept the so-called experiment going. Whether they were turtles or inspired by the turtles or never heard of the turtles, trend following has become accepted by those at least that have a pulse, those that have some intelligence. Maybe that makes it a fairly small minority still. Nonetheless, the turtle trader story was just fantastic. Nurture trumping nature. Teaching trend following, showing that trend following worked. It did, and it does. A skeptic reached out to me the other day, though, and they said, you used an example of Google in your book on the turtles. Well, that's wrong, because Google was not around then. So, if you make up something about Google, what else are you making up? Now, of course, he said that one example was most likely used by me to just show a current market, of course. The universality of trend following is what I was really showing. It didn't make a difference what one was trading in 1982, 83, 84, or today. As long as the market is liquid, as long as it trends, trend following works. So he fixated on that one thing, that Google was used as an example, and everything else in the book was invalidated because of that one issue. Now, that's no longer a skeptic. That's just crazy town. Now, that's fine. I welcome the crazy town listeners to my podcast. That's great. It gives me something to talk about. It gives me something to rile against. So for that, I'm fortunate. Yes, the book, The Complete TurtleTrader, my second book, is invalidated because one of the market examples used included Google. Today in the podcast, I have Brian Proctor. Brian is a managing director at EMC Capital. EMC Capital was started by Liz Cheval. Now, unfortunately, Elizabeth is no longer with us, but she was one of the original turtles. So Elizabeth's track record starts in 1985, continues with her firm EMC, and EMC continues to this day. Brian was also an original turtle in the Richard Dennis experiment. He joined Elizabeth at EMC after the firm was started, and to this day, he continues to help lead EMC as one of the original turtle traders taught by Richard Dennis. I hope you enjoy this conversation with Brian Proctor. Brian, Mike Covel.
Hey, Mike. How are you?
Not too bad. Not too bad.
You get up early. You sent me an email at 4:00 in the morning.
Well, I'm in Saigon.
Oh, you are? Okay.
So the real question might be, who was getting up early?
Well, I got up at 6 and I looked and I'm like, I got an email 2 hours ago. I'm like, holy cow.
You're like, oh, wow, this guy's really off his rocker.
What's going on in Saigon?
Let's see. I've been doing this podcast for 3 years, and I've been in and out of Southeast Asia since early 2013. I came here on a speaking tour. I was living in San Diego, and then one thing led to another, and I said, wow, this is kind of a cool place. I can stay here. So now I do all these crazy podcast episodes from Southeast Asia, huh?
Wow. Okay.
Hey, I was trying to think when we met, and I was writing it down. I think it was June of 2010 in Chicago at an MFA meeting, if I'm not mistaken.
I think you're right. I think we met because we were listening to a panel that had my old boss, Rich Dennis, and some of the guys and girls that I knew very well up to talk about their experiences with the mentoring program that Rich ran.
Yeah, well, obviously, and you were a part of that too. But let me jump in. So, as a managing director of EMC right now, commodity trading advisor, managed futures player, long track record back to 1985. And since you just kind of brought it up, I think it'd be a good thing to start with the audience, and then we'll kind of bring things forward to today, because it is one fascinating, and I'm sure there's probably a side of you that's like, oh my gosh, I don't want to have to say anything anymore. But it's still so fascinating to people out there to realize, and I guess for you, maybe it feels like a long ago school program, but it just so happens to have been a school program that was a very successful one. Why don't you talk about, Brian, I'm really curious, your first trading moments, how you got started, and what led you to the Turtle program?
You know, like Rich Dennis, I grew up on the south side of Chicago. So when I graduated from college in 1982 with a degree in economics, I went out and there was a big recession going on, and I thought I was going to get into investment banking somehow. But as I soon found out, they were laying more people off in the banking industry in Chicago than hiring. So just by chance, I ended up playing a round of golf, and in my foursome was a guy named Everett Clipp, who ran Alpha Futures, a big FCM, a big clearing member at the Board of Trade, where a lot of locals would clear their trades. As I played with Everett that day, he was asking me what I was going to do with my life, and I wasn't really sure, and I asked him what he did, and he started to tell me about the trading in the pits of Chicago, and I had heard about it but never seen him before. So, I bugged him a little bit, and I said, I'd like to come down and see how everything works down there, and if, maybe find a job down there. And he tried to dissuade me from coming into the business. He goes, no, you don't want to get in this business. It's a bad business to get into. Lots of people start in this business. They lose money. I wouldn't suggest it. So he kind of put me off. But I wouldn't take no for an answer, so I kept calling him, and finally invited me down to his office and showed me around and took me down to the floor, which was a tremendous experience. I'd never seen it before, and the minute I walked down the floor, I realized this is what I wanted to do. It was just that overwhelming. And so Everett. God bless him. He was a great guy. He took me under his wing, and he said, I think I can help you find a job. And there was a new firm starting up. The name of the firm was C&D Commodities. It was two guys, very famous locals down in the grain room primarily, Larry Carroll and Rich Dennis. And they were just opening a brand new firm, and Everett got me an interview at C&D, and I was probably, I want to say, maybe the fifth person they hired there as they were starting their new firm. So I got thrown right into the fire from the very beginning and worked on, started as basically a runner, phone clerk on the floor of the Merc first in the old black box when the Merc was, in its infancy. And then worked there for a while, and then moved over to the Board of Trade and kind of climbed the ladder at C&D pretty quickly, just because I'd gotten in the door first. So it was just a good stroke of fortune for me to have that opportunity, and I learned a lot. There were guys on the floor running the show for Rich Dennis, Danny Smith, Jack Callahan. Those guys, always at work every morning, 5 o'clock, ready to go. Great work ethic, and set a great tone and a great example for me. So I lucked out. So I got into the Turtle program really. I was running the floor operation in the grain room for Rich when he first decided to start this program, and he put the ad in the Wall Street Journal, and we'd come upstairs after the trading day was done, and there would be literally, gigantic sacks from the U.S. Post Office in our office, and we'd have to kind of weed through the mail and sort it, and Rich and Bill Eckhardt and some of the other guys up in the office would weed through these. And so, I witnessed the first round of turtles, if you will, that came in, and saw how successful they were. Over the course of the next year, Rich decided he was going to open it up and do one more round and bring in another, half dozen to 10 more traders into the program because it was doing so well. So it was at that point when I went to him and I said, look, what's my career path at C&D going to be here? Am I going to be, go into the pit and get a badge and execute trades for you? Or, with this Turtle program, would I be a candidate? And, what would you suggest if you were me? And Rich said, you can skip the floor, because even if you get a badge and you go into the pits, you're going to get tired of that mentally and physically, after 5-10 years. So why don't you just skip that phase and go right off the floor and start to learn how to trade off the floor? So that made it easy for me. I said, well, if you would consider me for the Turtle program, the second round here, why don't I make that move? I didn't have to go through, per se, the big, long interview process and answer. Well, I guess I did answer the questionnaires that he put out there. Anyway, that's how I got my start in the business. It was just kind of a stroke of luck that, ended up being in the right place at the right time. And, obviously the Turtle program and the opportunity that Rich afforded all of us was an incredible opportunity. It gave you the chance to learn how to trade and take the emotion out of it, because it wasn't your money, it was Rich's money. As you know, that we used a high degree of leverage in the Turtle program, so the opportunity to make triple-digit returns was there. Where our margin to equity was very high.
I'm looking at your returns that I jotted down for while you were in the program: 85, 55%, 86, 116%. In 1987, you had the highest return of any of the turtles in the program as 185%. So yeah, you're right. You guys were shooting for big returns at the time.
Well, I actually, in 1987, I lucked out a little bit, just because at the time at the time, a little bit before I started the Turtle program, I decided that since the trading day back in when I started on the floor, we worked from 7. Well, actually, we got in the office around 5, but the trading day would be done by, if you worked in the grain room, you were off the floor by 1:30. If you worked in the bond room, you were off by 2 o'clock. So I decided to go to law school down the street at John Marshall and get a law degree in the evenings. So I had a little time to study and then go to class. So I actually was literally the week and the days leading up to the 87 crash, I was taking finals in law school, and rather than worry about a lot of positions in my portfolio, doing my homework and working on the trading levels and stuff, I took a lot of my positions off or scaled back a lot of the positions going into my finals week in law school. When 87 happened and there was, a big disruption in the market, especially in the short-term interest rates and currencies, besides the equity market, I had very little exposure on, so I didn't take the gigantic hit that a lot of the other guys in the Turtle program. So that was a stroke of luck, actually. It had nothing to do with my exceptional brilliance or anything in that particular year.
Let me talk about one aspect of the program that I think is interesting and comes up to modern day a little bit. I think there's been a couple, I don't want to call them experiments, but some people that witnessed from afar the Turtle program, and they wanted to replicate it. I think there was a British guy that was going to teach day trading to somebody or some group of people. But I think what people sometimes forget is that this program, depending on whether you came in the first year or the second year, was 4 years and 3 years. So this was a lot of time. And, I think people want to think that there's something to film, there's some sexiness to it, but having a good strategy and sticking with it and having the discipline to stick to that strategy doesn't mean that there's a bunch of people in a room jumping up and down like the trading floor. And I think still to this day, people want to imagine some physical activity, and whereas I think you'll probably have added this, it's more of a cerebral game.
Definitely. I mean, it's there's a lot of when you're building systematic trading models, when you have the blend of systems and you have your risk management parameters preset, then it's really there's not a whole lot of excitement. You have some busy days, and in the old days we used to be on the phone a lot. You'd have to call the floor, you'd have to call the sugar, the people in the softs pit, or you'd have to call the crude oil or at the board or the Merc. So you had a lot of phone calls to make trades when there was a big burst of activity, but a lot of time, there's just a lot of downtime so you could spend that time, either looking at new ideas or trying to test new ideas, or doing homework in some other area. So you're right. I mean, there wasn't a whole lot of activity or emotion, when the time came, having a disciplined approach. Actually, that was the hardest part, was to just have the discipline to do what the system, when the signals are generated. Sometimes it was counterintuitive. You'd look at it and say, I really don't want to buy the market up here. I don't want to sell this. I remember being short crude and taking a short position at below $10 a barrel back in, I think it was 87. So, that probably was the hardest part about what we had to do was taking some of these trades that were very difficult. And Rich always said, doing the hard thing is when you do the easy thing, you're probably going to lose. You do the hard thing, and it's probably going to turn out okay. That
confidence that was instilled at you at a young age, that's something that's never wavered. I mean, for example, in the last 3, 4, 5 years, it's been the latest rounds of systematic trend following CTA style trading is dead. Now, from your perspective, going back to the early 80s, I'm curious, how do you feel when you see these stories? Because you're looking at the markets and systems from a much different perspective than what people that are not familiar with your style of trading. They see the headlines and they get excited by the headlines. But from a confidence perspective, really well deep in your gut, those headlines don't really amount to anything. It's all about the system, the rules, sticking with it.
Absolutely. That was, Rich said, the two most important things you can learn from this program are, number one, you have to be very disciplined, manage your risk, take your losses, have an unwavering discipline when it comes to that. And the second most important thing is, when you're doing your testing and you're coming up with new trading ideas, new trading models, to just have some very robust parameters out there to make these systems operate. Honestly, I mean, our best systems now, if you have a system that has a 40% winning percentage over a long period of time across all the markets we trade, that's a phenomenal system. And so what that tells you is you're going to have more losing trades than winning trades. The discipline of letting your winning trades run and cutting your losses is where you make your money. It sounds simple and you hear a lot of people say it, but the truth is, it can be a very difficult thing to do month after month, year after year. So when we do go through difficult periods for our particular style of trading, such as after '08 up until 2013, we had an up year, down year, down year, up year. We kind of went sideways to negative for quite a long time, the longest period I can remember in this business. And it would have been easy to kind of say, maybe our models are broken. Let's let's change things and let's move to, let's do things differently. And we at EMC decided, not to do that, we've seen these kind of periods before. You never know when the next successful period is going to come for our style. The financial engineering that was going on around the world, the central banks and the governments of the world propping up asset classes and trying to control interest rates and currency flows and things. They were obviously very successful at that, which made it difficult for us. But, we'd see little glimmers of hope of markets starting to diverge and follow their own kind of supply and demand, or, the other fundamentals that normally drive markets. And so we were cautiously optimistic that that at some point, the long sideways to negative performance would end. And of course it did over the last, for us over the last 12 months. It's been, in our classic program, close to 40% over that time period. That's just the nature of our return stream. And if your investors understand that and they're comfortable with it and they know it's a long-term investment, they're going to understand we're going to have periods where performance is going to be difficult, but as long as you have long-term positive expectation, the benefits, obviously the non-correlative benefits of adding us to an investment portfolio really make it worthwhile for investors.
Brian, EMC Capital was started by a fellow turtle, Liz Cheval. She's unfortunately no longer with us, but I'm curious if you might go back and give some perspective about working with her, what she's instilled in the firm that to this day is still an integral part of EMC.
Sure. I mean, she obviously, we were friends way back in the early days, and we got to trade in the same room together and get to know each other. And she was always, a pleasure and a really a wonderful person. Over the years, after the Turtle program ended and everybody went out on their own, Liz formed EMC. Through her perseverance and her personality and her intellect, she partnered up with a couple of very good partners in this business, that being Dearborn Capital Management and Morgan Stanley. She cultivated those relationships very well over time, in addition to having great performance for them. Her ability to run a business as well as be a successful trader was, it's just a testament that EMC is still running here, even though she's passed now for 2 years. All those values were instilled in the people here at EMC. I've been here for 10 years, so I went off and did my own thing. I ran a CTA for a while. I went back and ran Rich's trading operation for a while. I moved to New York and traded for a hedge fund, a long-short equity firm for a while, and then came back to Chicago, met up with Liz, talked about our business. I ended up here, which was very fortunate. The carryover from the lessons that Rich and Bill instilled in us, still the same basic philosophy. You're looking to continuously look to improve your trading models or build new trading models that complement the ones in the portfolio. So it's an ongoing discipline of continuous research, using the advances in technology to your benefit. So now we've reinvested enormous sums of money back into our infrastructure here in terms of research and trading, so that we're at the forefront of quantitative analysis here, and then to have the discipline to build systems based on trend following and momentum. It's always about directional price movement. It's never about trying to pick tops or bottoms, and then implementing them in a way that you spread the risk out across the markets and the systems that you trade. Get as much diversification as you can and manage your risk. It's really all about having a big database across numerous markets, lots of data points, daily data for 80 markets looking back, 20 years. So it's how do you efficiently and with a certain degree of speed, how do you look at all those possible variables when you're building a trading model that might have anywhere from, say, 8 to 13 parameters, the parameters being the type of price action that gives you initiation signals, the type of price action that gives you how to liquidate those trades, and then there'll be filters, there'll be filters in there that deal with things like volatility or delays or things like that. So, when you're optimizing a trading system using this newer technology, what it basically allows you to do is open your parameter sets much wider than you would have been able to in the older days when you did a lot of this by hand and then went back to the machine and had them rerun. So the biggest benefit is opening up the parameter sets and allowing the speed of the computers to just do multiple iterations, just millions of tests. It's a natural progression of the best parameters in the trading model rising to the cream rises to the top, and that's how you optimize your trading system. Obviously you have to be aware of possible pitfalls that come with curve fitting. To get around that, you don't optimize to one metric. You use a blend of metrics, and by that I mean you can mix a return element with another concept such as efficiency or Sortino or something like that. That's one way to prevent curve fitting. Another way is to obviously create an out-of-sample hypothetical return set and then compare that to what you actually were producing when you're re-optimizing existing systems or building new systems to see if actual trading mimics your hypothetical returns.
There still seems to be a significant number of traders, your firm included, though, that do have core trend or systematic approaches, trend following type approaches. And do you ever find it kind of amazing when you look back and you say, wow, some of these men that I learned from all these decades ago, and look, Richard Donchian before Rich and Bill and some of the other guys in the 70s, it's amazing that these core philosophies and many core strategies have continued to excel.
It's just a testament, I guess, to human nature. Markets are not always rational. They're not always efficient. On top of that, there really are things that drive markets besides human emotion, whether it be supply and demand or changes in technology or geopolitical events or some kind of economic upheaval. When those happen, a divergent strategy like ours, the assets are going to be mispriced across the board. There's going to be some sharp money flows in response to the mispricing of assets. The efficient market, when things are status quo and the world is not in upheaval, then you're going to have slow, steady, progressing markets. Over time, from one decade to the next, there's always the unforeseen, the unexpected, the sea change in one asset class or a number of asset classes that people have to react to, and you get long, pronounced trends. If you have systems in place that are designed to capture those, and you have the discipline to, say, get short crude oil at $100 a barrel, if it goes down to $80, a discretionary trader may, if there's a little bit of consolidation there, decide to take the position off, and then it may gap down $2 the next day, and it makes it hard to reinitiate a position the next day unless you have that mentality that, this trend could continue much further than, I envision right now. Yeah, it's amazing that these programs, that, the old guys, the pioneers in our business envisioned working and experienced, they really understood the nature of the markets, and that there will be great profit opportunities in a wide variety of markets if you have the discipline to do it the right way.
They're not going to hand out the Nobel Prizes to traders anytime soon, I don't think. But all of the guys that get these Nobel Prizes, and some of them are extremely brilliant, I'm not taking anything away from them, but it seems like some of the traders that actually figured out all their lessons that they got the Nobel Prizes for long time ago already in the markets, in the pits, etc.
Yeah. Well, I think if you asked Rich or any of us, we're not anywhere close to being that deep of thinkers or that much in academia. It's just kind of a learning experience.
But it's the results.
It's more of putting your nose to the grindstone and doing the right thing day after day than coming up with some world changing.
Let me ask you about diversification. I received an email the other day. And somebody was asking me about the Swiss franc move in January. And I've talked about this in my podcast before. Other people have commented on it. And this person wrote me, they said, I don't understand these strategies, the quant trend type strategies. If they're trading the Swiss franc in January, how do they not lose 30 or 50%? And I think what people don't get is that, and I want you to comment on this and talk about this, is that you're not betting the ranch on each market. That's number one. And then number two, if you do happen to have losses, which you're going to have, there's also going to sometimes be gains, and the gains can offset the losses. Why don't you talk about that? Because I think that's a big picture concept that you might even face with. These days, I'm sure many of your clients get what you guys do, but still, there's going to be very bright, very wealthy people that still might not appreciate this idea that, well, we didn't get blown out on the Swiss franc because our position size was such that we weren't going to. And then number two, our other gains can offset. What do you talk about that, Brian?
Sure. Well, there was that was kind of a unique situation because of the peg that the Swiss National Bank had put into place. And once it got below that peg, and there were traders out there, certainly discretionary traders, who looked at it and said, what's the risk here? We got the ECB about a month away from their new QE program, if you will. So there were guys who looked at that and said, something could happen with the peg here. I'm not comfortable with this position, and just took it off. We didn't do that. We were still short the Swiss franc, but as you said, every trade that we take, there's a limit to the amount of risk that we'll put in any one trade, in any one market, in any one sector. The risk of ruin gets greatly reduced as you spread the risk out across 80 some odd markets across the globe. The Swiss franc only is going to get a certain small percentage of the total risk in the portfolio. Now, that said, for us, on the day of the decision to remove the peg, we were short. We lost a little over 2% in the Swiss franc that day. But at the same time, you have to remember we were long the Euro Swiss, which was the interest rate component of that. So the Euro Swiss actually that day and then for the ensuing week after that had a tremendous rally as the short-term rates went further into negative territory. So, we had the diversification to offset a lot of the loss that we took in the Swiss franc that day with some of the interest rate exposure we had there, plus being long the DAX, which has gone up about 25% since January, because of this QE program and because of what's going on over in Europe with the attempts to stimulate their economy. The diversification really does play a role. The limit of risk in each market and in each sector that we trade plays a role. We've seen currencies go through pegs before, and we've seen, banks and central banks and other entities, say one thing and do another thing. So we really can't base any of our trading decisions on what might happen or might not happen. Our models are really designed to react to what's going on in the marketplace rather than try to be predictive.
I have this jotted down in my notes here, quote, every now and then the impossible can and will happen, end quote. And it's such a simple thought, but how many of us go wrong on that, huh?
Yeah, every now and then you do get something that just defies logic. this, I wouldn't say this defied logic. It was just an event that, in retrospect, you can look back and say, oh yeah, we should have seen that coming, or oh, that would have been really easy to predict. But the reality is, in the moment, as you're looking at it, you don't know what's going to happen. And the Swiss obviously are very good at being secretive about what what they do. So, for us, it's responding to things that happen in the market rather than trying to predict the next black swan or trying to imagine the next gigantic price move in some market. You just have no idea.
I did not ask anything in the beginning of our conversation today, but I'm curious, looking back in time, how are you influenced by Bill Eckhardt?
By Bill Eckhardt? Well, Bill, was kind of the quant of the duo of Rich and Bill. I think Rich was the more intuitive trader, started in the pits and had a knack, obviously, for assessing situations and was comfortable taking risk and managing that risk, and obviously built a fortune. He recognized the brilliance of Bill and his mathematical approach to trading, and so it was a good partnership for them. You had the intuitive ideas that could be, or at least attempt to put those ideas into mathematical equations. And so it was really, I think their partnership was great, in that each one of them kind of had a unique contribution to the overall success of their partnership and of the Turtle program in general.
Yeah, I think we can all, maybe people aren't going to agree with me, but I don't think there's ever going to be a repeat of that particular event. I think the fact that it happened before the internet, where everybody wants cameras everywhere today and all that kind of stuff, I think it's just this naturally occurring event, seminar type program put in place by two men behind the scenes. And then when it was over, everyone learned of it and learned of the success. But I think it's going to be something where even 50 years from now, 100 years from now, people are going to look back and go, that was a really cool thing.
Well, being a part of it was definitely, the changing point of my life. So personally, I owe those two guys, really everything that I have right now. Is they put the programs in place and taught me some invaluable lessons and how to think about things and how to look at things. And so you're right. I don't know if there'll ever be anything quite like it. There might be something cooler that happens, honestly, in the next 10 years. For me, just being a part of it, with the friendships, I still see a lot of the guys out there, not as much as I used to, but we keep in touch, and they're, obviously everybody's program has evolved and changed over the years to one degree or another. I think, it's, just the nature of the business is how you're going to, or I guess the nature of our business, how you're going to position yourself, what kind of products are you going to build and offer in the marketplace? So, we're the sub-advisor of a multi-strategy 40 Act fund now. If you would have floated that by me, 5-10 years ago, we would have said there's no way we'll ever be part of a mutual fund offering. You just, you never know. Your business models and investor appetites ebb and flow and change over time. If you have a nice suite of products, if you will, that you can offer them, we kind of have a little something for everybody here, I think.
I'll leave you with this. I saw a comment recently and from one of your Turtle peers, and essentially said, hey, before we rule active strategies out, before we say that they're no longer valid, let's let the equity bull come down a little first. So I think it's interesting that even given the massive equity bull of the last 4, 5, 6 years, it's amazing to look at the performance from a lot of trend quant strategies, especially in 2014. Not everything goes up. I think it's going to be really interesting to see as the years unfold. And this is not a prediction or anything. I have no crystal ball, but I think everybody with a pulse out there knows that your type of strategies do extremely well when turbulence appears.
Well, historically we have, and I hope that proves to be true when the great unwinding begins to happen here. And honestly, it's impossible to decipher how it's going to unfold. Whether, when the bond rally finally ends, how it's going to end, why it's going to end. The equities will probably have an adverse reaction when that's happening. So it's going to be, we haven't been here before. So really, it's anybody's guess how it's going to, anybody can say it's going to end badly, but maybe it won't end badly. Maybe it'll be a smooth unwinding. Maybe it'll be, it'll just be markets will kind of go back to normal, and it's impossible to tell, honestly.
Your strategies will go either way, though.
Exactly. I mean, if there are money flows out of bonds and into other asset classes, we will be selling bonds and buying those other asset classes. Or, if the equity world gives back some of these extraordinary gains that they've built up over the last few years, then we'll be short in the equity markets and profit from, whether it's a relatively short downturn or a more steep, dramatic downturn. You're right. I mean, we're positioned, and our models are nimble enough to be able to turn and profit from any directional price movement in any market.
Brian, I can't keep you. I'd love to have you on again. Where's the best place we can send the audience to check you and your firm EMC Capital out?
Our website is www.emccta.com. And then, there'll be some information on our firm, our programs, and a way to contact me if you'd be interested in talking about our programs in more detail.
Brian, I appreciate you taking the time today. How's Chicago weather this morning?
Well, it got cold finally, but when I was walking the dog last night at 7 o'clock, it was 70-something degrees. When I walked the dog one more time at 10 o'clock last night, it was 50 degrees, and now it's in the 30s. So we're getting a little blast of cold, but, spring's right around the corner now.
Well, the next time you stop by Southeast Asia, I can give you a little dose of not cold.
Last time I was in Singapore, it was like 90% humidity in the mid 90s, and I thought, oh my God, I couldn't live in this. Walking down the street, I was drenched in sweat within 5 minutes. I
mean, the only thing I could wear are t-shirts. I mean, I can't. If I put a long sleeve shirt on, I'm dripping. Hey, listen, Brian,
okay.
Thank you for joining me. Take care.
Yep, Michael, thank you.
Bye-bye.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.